3 days ago, on the 1st of April, 2026, the Reserve Bank of India quietly flipped a switch that will never be flipped back. As of that date, every commercial bank, every rural cooperative, every non-banking financial company operating under Indian regulatory authority is now legally permitted to accept silver as loan collateral, 10 kilograms of silver ornaments, 500 grams of silver coins, 85% loan-to-value ratio. This is not a pilot program. This is not a consultation paper. This is live enforceable law governing over 1.4 billion people in a nation that already imports more silver per capita than any major economy on Earth. For the first time in modern monetary history, a sovereign nation has formally elevated silver to the same shelf as gold inside its banking system. And while the Western financial press spent Easter weekend writing about oil prices, Kevin Warsh and a missing American pilot in the mountains of Iran, not a single major outlet in New York, London, or Frankfurt led with the fact that 250 million Indian households just received a legal mechanism to borrow against silver that sits in their family vaults. Someone is not telling you the whole story. Tonight, I am going to show you who, and I am going to show you why the paper price of silver sitting at $73.75 is the single most mispriced number in contemporary finance. This is OG John AG, no sponsors, no asset managers whispering buy signals while their compliance department files the opposite trade. No institutional desk analyst whose bonus depends on you holding the wrong end of the trade, just data, just filings. Just the questions that should be asked but will not be because the answers lead back to the same banks, the same exchanges, and the same custodians that write the checks. If you are new here, subscribe, because by the time this information reaches mainstream commentary, the positions will already be closed and the profits already booked. Let me start with a name that almost nobody in the silver community was talking about 6 months ago, and that every serious analyst is now forced to reckon with. Jane Street, a proprietary trading firm headquartered in Lower Manhattan. In the fourth quarter of 2025, Jane Street held approximately 41,000 shares of the iShares Silver Trust. By the end of the same quarter, according to regulatory filings reviewed by multiple financial news outlets, that position had swollen to approximately 20.6 million shares, a 500-fold increase in 90 days. The accumulation made Jane Street the largest reported holder of the world's largest silver exchange-traded fund, surpassing even BlackRock, the fund's own sponsor. During the same window, Morgan Stanley cut its SLV position by 3.7 million shares. BlackRock itself added nothing. Only one firm moved with this kind of velocity, and that firm reports that over 87% of its $662 billion in holdings are tied to options. This is not a pension fund quietly rebalancing. This is a volatility shop with the balance sheet of a sovereign wealth fund and the reflexes of a high-frequency market maker taking a position the size of a mid-sized nation's silver reserves in a fund whose custodian is J.P. Morgan Chase, the same institution that in 2020 paid $920.2 million to settle federal spoofing charges involving the manipulation of precious metals futures over an 8-year period involving hundreds of thousands of deceptive orders. No new allegations have been filed against Jane Street specifically. No American regulator has announced a formal investigation of its silver exposure. But the structural question is already being asked in trading rooms from Chicago to Singapore. What does it mean when the biggest volatility trader in the world takes a historic stake in a physically backed silver ETF whose custodian has a criminal record in precious metals manipulation, while silver prices are falling and every other institutional holder is either reducing or standing still? It means someone has a view the rest of the market has not caught up to. It means the position is a bet, and bets of this size do not get placed without conviction about where the price will move when the catalyst arrives. Now let me show you exactly what the exchange did to create the crash that allowed this accumulation to happen. On the 30th of January 2026, silver closed at its all-time intraday peak of $121.64 per ounce. On the same day, CME Group announced a margin increase on its precious metals futures. The initial performance bond requirement on COMEX 5,000-ounce silver futures had already been raised from $22,000 per contract to $25,000 per contract in late December, a 14% increase. The January 30th adjustment took the margin parameter from 11% of contract value to 15%, with higher tiers moving in tandem. 1 week later, on the 6th of February, a further adjustment pushed that parameter to 18%. In a span of approximately 40 days, the cost of holding a leveraged silver position rose by nearly 2/3. Spot silver plunged 27% in a single trading session on the 2nd of February, the worst single-day percentage drop on record for the metal. Over the following 3 weeks, silver retraced from $121 to roughly $70, a 33% collapse in the face of unchanged physical fundamentals. Anyone with a memory longer than a news cycle will recognize the playbook. In January 1980, the same exchange enacted Silver Rule 7 against the Hunt brothers, forcing effectively 100% cash collateral and halting new margin buying. Silver fell from nearly $50 to $10 by the end of March that year. In 2011, the CME raised silver margins 5 separate times in 9 days as silver approached $50 again. Prices collapsed by 30% within weeks. And now in 2026, the exact same tool has been deployed at the exact same moment the retail public finally arrived at the party. The difference this time is that the physical market did not cooperate with the paper market. While futures traders were being force liquidated, registered silver was leaving COMEX vaults at a pace that has no precedent in exchange history. The numbers on that drain are publicly verifiable. In a single week of early January, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses for delivery. That represented approximately 26% of all registered inventory disappearing in 7 trading days. For 15 consecutive months through the beginning of this year, the exchange has processed delivery volumes it had never processed before. December of 2025 produced 65 million ounces in deliveries, a single-month record. January of 2026 followed with 49.4 million ounces, more than 7 times what the same month produced in 2024. The full calendar year of 2025 settled 474 million ounces of physical silver against 203 million ounces the prior year. The volume more than doubled in 12 months without a single headline event the general public could name. COMEX registered inventory dropped from approximately 240 million ounces in April of 2020 to 86.13 million ounces by February of 2026, a 64% decline over 6 years, with the steepest acceleration occurring in the months immediately following the January squeeze. The most recent published figure I can verify places registered silver at approximately 76.4 million ounces as of the end of March. 11.6 million ounces withdrawn in 30 days. Coverage ratio against paper claims at 13.2%, deep inside what analysts classify as stress territory. Paper leverage at 7.6 to 1. Depletion clock at 145 trading days if the current pace of withdrawal holds. These are not opinions. These are numbers published on the CME Group website every business day. Shanghai is mirroring the same pattern from the other side of the Pacific. Shanghai Gold Exchange and Shanghai Futures Exchange inventories have plunged by 193 million ounces since their 2020 peak, with February of 2026 showing a drop to approximately 318.5 tons from 559 tons in November of 2025, a 43% decline in 3 months. Combined COMEX plus Shanghai drawdowns account for roughly 161 million ounces over 6 years, which represents only about 1/5 of the cumulative 5-year global supply deficit. The remaining 4/5, approximately 659 million ounces, has been absorbed by irreversible industrial consumption or sequestered in private institutional vaults that never report to any public ledger. The silver that went into solar panels, AI server power buses, medical devices, and electric vehicle components is not coming back to any exchange at any price short of a structural repricing. China made its strategic position explicit. On the 1st of January 2026, Beijing formally added silver to the list of dual-use strategic materials, requiring state export licenses for shipment. Only 44 companies were approved. New exporters must demonstrate annual production capacity of at least 80 tons and credit facilities above $30 million. The country that refined and shipped more than 4,000 tons of silver in the first 11 months of 2025 has placed it behind a bureaucratic wall with no sunset clause, using the exact template Beijing applied to gallium and germanium. And while restricting outflows, China simultaneously accelerated inflows. Chinese customs data shows the country imported more than 790 tons of silver in the first 2 months of this year, an 8-year high, including nearly 470 tons in February alone, the highest February figure ever recorded. Hong Kong premiums on large silver bars reached as much as $8 over the London benchmark during that window, when they normally trade at a discount. The world's largest consumer is also its largest refiner, and it is simultaneously hoarding metal at home while choking off foreign access to the refined product. Any honest analyst looking at those two data streams together arrives at the same conclusion. Beijing has decided silver is a strategic national security asset and is acting accordingly. Mexico is the missing piece. On the 11th and 12th of March 2026, the United States Trade Representative launched Section 301 trade investigations targeting 16 economies, explicitly including Mexico, for alleged excess manufacturing capacity. April 15th is the comment deadline. May 5th is the public hearing. July brings the USMCA review. Fresnillo plc, the largest primary silver producer in the world, operating entirely inside Mexico, cut its 2026 production guidance by 9% before any tariff effect was even priced in. First Majestic Silver, another heavily Mexico-exposed producer, guided approximately 11% lower at the midpoint. Mexico alone produces more silver than the entire United States consumes in industrial applications annually. If that metal is diverted away from American accessible refiners and dealers through tariff friction or retaliatory supply disruption, the already strained Western physical picture tightens further on top of a sixth consecutive annual deficit. The Silver Institute has now formally forecast at 67 million ounces. Total global supply for 2026 is projected at 1.05 billion ounces, a decade high, and it still cannot close the gap. 5 consecutive years of deficit have produced a cumulative shortfall above 800 million ounces. An entire year of global mine production quietly vanished. Now put the India piece back on the table. The Reserve Bank directive that went live on the 1st of April formally sets a 10-to-1 silver-to-gold collateral ratio inside a national banking system for the first time in modern history. A household can pledge 10 kilograms of silver jewelry for a loan up to 2.5 lakh rupees, roughly $3,000. Gold requires only 1 kilogram for the same facility. By elevating silver as a parallel monetary collateral asset and simultaneously excluding ETFs, mutual funds, and bullion bars from eligibility, the RBI has done something no Western regulator has dared to do. It has drawn a line between paper silver and physical silver, and it has placed legal weight only on the physical side. Indian households, which hold an estimated pool of physical silver significantly larger than most Western central bank gold reserves by weight, now have a direct channel to monetize that silver without selling it. The policy does not merely increase demand, it locks up existing supply inside a lending collateral pool that cannot be sold while a loan is outstanding. Over the coming 12 to 24 months, analysts estimate that 250 million Indians could use silver as collateral under the new framework. Even a modest participation rate would remove tens of millions of ounces of retail-held silver from any possible sale channel. This is silent, structural, one-way demand from the country that is already the world's largest silver importer. The bear case remains on the table and deserves direct engagement. SLV has seen meaningful short-term outflows since the January peak. JP Morgan is publishing research that averages silver at $81 for 2026, which is lower than the peak pricing of late January. If the Strait of Hormuz reopens, inflation repricing could partially unwind. Bank of America still warns silver has overshot its fair value estimate near $60. Solar thrifting is real, and Bloomberg NEF data continues to confirm that photovoltaic silver loadings per cell are engineered down every manufacturing cycle. And CME's own transition to a floating percentage margin system introduces pro-cyclical volatility that can amplify any future correction. Dismissing these counterforces is a form of intellectual laziness your capital cannot afford. But here is what the bear case cannot account for. The Sprott Physical Silver Trust doubled its at-the-market equity program to $2 billion in January, which at current prices represents purchasing power of approximately 18 million ounces, roughly 16% of total COMEX registered inventory in a single institutional capital raise. BHP, the largest diversified miner on Earth, monetized its Antamina silver byproduct to Wheaton Precious Metals in the largest streaming transaction by upfront payment in history, $4.3 billion in cash for silver linked to its share of production over the life of a Peruvian copper mine. 5-day SLV net inflows turned positive at $370 million, even as longer-term outflows dominated headlines, indicating an institutional divergence between short-term tactical selling and deeper accumulation from entities willing to buy the crash. Samsung's solid-state battery program, validated with BMW and Solid Power for late 2026 evaluation vehicle integration, requires approximately 1 kilogram of silver per 100 kilowatt-hour pack, against 25 to 50 grams in current lithium-ion cells. A 20% solid-state penetration rate across 16 million vehicles annually would add 16,000 metric tons of new annual demand, approximately 514 million ounces, layered on top of every existing industrial application. And silver lease rates in London spiked to 39% in early October of 2025 before easing, levels the market had not witnessed in 4 decades, because holders of physical metal became unwilling to lend it even temporarily at any normal rate. So here is where you stand on the 5th of April, 2026. Silver spot price sits at $73.75. The Strait of Hormuz remains closed on Easter Sunday, with the President of the United States posting on Truth Social less than 24 hours ago that Tuesday will be designated Power Plant Day and Bridge Day in Iran if the waterway is not reopened. Oil is hovering above $100 per barrel. The Federal Reserve cannot cut rates without pouring fuel on a 3.1% core PCE fire, and it cannot hike without accelerating a labor market already shedding jobs. Real interest rates are collapsing as inflation runs above the policy rate, which is the precise environment in which silver has historically delivered its most extreme performance. Jane Street holds an unprecedented 20.6 million SLV shares. India's remonetization rule is 4 days old and live. China is stockpiling 790 tons in 2 months while choking off exports. Mexico's primary silver producers have cut guidance before any tariff effect is even scored. The Silver Institute has formally projected a 6th straight annual deficit, and the COMEX depletion clock reads 145 trading days. One of these stories is true. The paper price or the delivery notice, the CME margin announcement, or the Sprott $2 billion at-the-market program. The Bank of America $60 fair value estimate or the Jane Street position report. When the Fed either cuts or does not, when the strait either opens or does not, when Mexico either absorbs the tariff review or retaliates, the repricing will not announce itself on a Bloomberg terminal. It will announce itself in a delivery truck, in a vault receipt, in a margin call going the opposite direction, and it will arrive into a market where 76 million ounces of registered COMEX silver stands between the largest paper leverage ratio in modern history and the physical reality that every solar panel, every semiconductor, every solid-state battery prototype, every data center, and every AI chip fabrication line on Earth requires a metal the world is consuming faster than it can mine, faster than it can recycle, and faster than vaults can refill. If you made it to this sentence, you are not here by accident. You are the reason this channel exists. You read the filings. You count the bars leaving the building. You watched the January crash, and instead of panicking, you asked who was on the other side of the trade. That question is your edge. Do not let anyone take it from you. If this video earned your time, hit the like button. Share it with one person who still thinks the screen price tells the whole story. Subscribe if you have not already. And drop OG John AG 2.0 in the comments below. Not because the algorithm rewards it, because when the next viewer scrolls into this video and sees that phrase repeated 1,000 times, they know instantly that this community does not trade on headlines. It trades on data. It watches vault reports. It verifies every claim, and it stays until the last word. Invest with logic, never with noise. OG out.